Despite the political and economic difficulties that we all had to face in 2018, I think it was a surprisingly interesting and, dare I say it, not so bad year. Yes, the second half was more challenging than the first half. New issuance and new borrowing clearly slowed down. And that was a function, or that was the result, obviously, of the economic headwinds that we're facing, namely the trade war between the US and China, economic and political uncertainty in Italy, and, of course, the mother of it all, Brexit.
It was quite a year, and so much so that I'm not quite sure I can remember one like it. The sheer pace of movement of the documentation, driven by a number of factors, including the deal volume and the number of market participants, active market participants in the term loan B space, the sheer pace was quite something, which made for a very enjoyable year. It made for a satisfying year. It made for, I think, a lot of market participants managed to get the deals done that they needed to get done.
We've seen a significant diversification in the credit products on offer to borrowers and issuers. This is a phenomenon that has emerged in the last 2 or 3 years in particular. First of all, the biggest development has been the rise of CLOs, or, if you will, the return of CLOs, because they have come back in force. They were there before, and they disappeared for a while. This has allowed banks greater flexibility to syndicate. Therefore, banks are back in the game. And secondly, the CLOs are vehicles that invest in floating rate products and therefore favor loans. As a result, this has skewed demand away from bonds towards loans. The second big development, in my view, has been the emergence of direct lending as a mainstream credit product.
Statistically, in 2018, direct lenders, not by value but by volume, occupied roughly 50% of the market space. So they have arrived. And with the hunt for yield and with their access to the treasure chest of liquidity that's become available courtesy of quantitative easing, those funds have been very keen to put their money to work, just as the investment banks and other traditional financiers have been in the 2018 space. Certainly noticeable and certainly welcomed by many of the private equity sponsors who've I think, welcomed the additional competition in the space from a debt perspective.
And as a result, I think that any sponsor looking at an acquisition scenario will consider a greater range of products, and therefore, in kind of the preparations for making a bid, will probably go multi-track as long as they can until the final moment when they have to choose a product.
I'm reservedly optimistic about the 2019 outlook. Duly noted that there are a range of uncertainties and risk factors out there, all of which have been well documented: Brexit, geopolitical concerns, so on and so forth. That said, there remains an abundance of capital available to be put to work in the European market spaces. The equity and the debt side both have the firepower to do deals. We also have an underlying backdrop of relatively, certainly of acceptable economic growth across some of the major markets. We also have participants that are willing to do deals. The debt and the equity side are absolutely out there looking to do deals in 2019.
Combined with the fact that the European market is much more robust than it has been in the past, leads me to be reasonably optimistic that things will get going again in the second quarter of this year, even.